You've been investing for years, but your passive income from dividends is still not enough to give you financial freedom. Or worse, you keep accumulating stocks, but it feels like your money never works in your favor the way it should. If that's the case, you might be making mistakes that are slowing down your financial independence without even realizing it. Today, I'm going to show you the 3 most common mistakes that prevent investors from living off dividends, and, more importantly, how to fix them to speed up your results. If you want to turn your dividends into a reliable and sustainable source of income, stay until the end, because a simple adjustment can make all the difference on your path to financial freedom. Many investors fall into the trap of choosing stocks solely based on high dividend yield, believing that the higher the payout, the better the investment. But this is a major mistake. A company that pays excessively high dividends may be distributing more than it can sustain, compromising its growth and, in some cases, even its survival. When this happens, what seemed like a great investment can turn into a major headache. Let's look at a real example. Imagine a company that has always paid good dividends but suddenly faces financial difficulties. To maintain payouts, it starts distributing more than it actually can, draining its cash reserves. In the short term, investors think they're earning a lot, but suddenly, dividends get cut, or worse, the company collapses. We've seen cases like this in Brazil and around the world, such as IRB Brazil and Oi, which attracted investors with promises of generous payments, but ended up disappointing many people. So, how do you avoid this mistake? Simple. Instead of looking only at the dividend yield percentage, analyze the payout ratio, the percentage of profit the company distributes as dividends. A very high payout can indicate risk, especially if the company lacks sustainable growth. Additionally, check the company's dividend payment history. Consistent companies tend to maintain or increase their dividends over time. Another essential point is to assess profit growth, because healthy dividends come from companies that continue to generate profits and expand their businesses. The second mistake that prevents many people from living off dividends is not reinvesting their earnings. Many see dividends as extra money to spend on daily expenses, but by doing so, they lose one of the most powerful forces in finance: compound interest. Reinvesting dividends allows your capital to grow exponentially, accelerating your journey toward financial independence. To better understand this impact, let's make a comparison. Imagine 2 investors. One withdraws dividends for personal expenses, while the other reinvests everything. After 20 or 30 years, the second investor will see their portfolio grow at a much faster pace because they are constantly buying more shares and, consequently, receiving more dividends. This snowball effect can be the difference between taking 10 or 30 years to achieve financial independence. And the solution is simpler than it seems. Use automatic reinvestment if your brokerage offers this option, or manually reinvest your dividends periodically. The key is to maintain discipline, because that's what will ensure your wealth continues to grow consistently. If your goal is to live off dividends as quickly as possible, reinvestment needs to be a fundamental part of your strategy. Now let's talk about the third mistake, and this is one of the most dangerous: lack of diversification and strategy. Many investors concentrate their capital in just a few companies or sectors, believing that choosing only the best payers is enough to guarantee a stable income. The problem is that entire sectors can go through tough times, affecting not only stock prices, but also dividend payouts. Want a real example? During economic crises, sectors like banking and oil can experience sharp declines, leading to reduced dividends. If an investor puts all their money into these sectors, they could see their passive income drop overnight. This happens because, by relying on just a few companies or a single sector, you expose yourself to risks that could be mitigated with a more balanced portfolio. So, how do you fix this? The key is diversification. Hold stocks from different sectors, and if possible, invest in assets that pay predictable dividends, such as real estate funds and dividend ETFs. This ensures that if one sector faces difficulties, your passive income won't be drastically affected. Additionally, diversification doesn't just mean choosing different companies, but also balancing sectors and asset types to build a portfolio that can withstand different economic cycles. Another mistake many make is ignoring the importance of taxes in their dividend strategy. In Brazil, dividends are still exempt from income tax, but this could change in the future. In international markets, such as the United States, taxes are applied to dividend income. If you don't consider this impact, you might end up receiving less than expected. The solution here is simple. If you invest abroad, you need to consider tax withholding at the source, and if possible, look for strategies to minimize this impact, such as investing through accumulation ETFs that automatically reinvest dividends or using tax treaties to avoid paying more than necessary. Another very common mistake is failing to adjust your portfolio over time. Many investors buy good stocks and simply forget about them, assuming they will keep paying good dividends forever. But the market changes, and companies that were excellent in the past can lose competitiveness, affecting their ability to distribute profits. That's why it's essential to review your portfolio periodically. This doesn't mean you should sell all the time, but you should track financial reports, business growth, and especially whether dividends remain sustainable. If you notice that a company no longer has solid fundamentals, it might be time to reallocate your capital to a more promising opportunity. Now that you know these mistakes, it's time to take action to correct them. Avoid falling into the trap of high dividend yield without analysis. Reinvest your dividends to accelerate portfolio growth. Diversify your investments to ensure a stable and sustainable passive income. Pay attention to tax impacts and review your portfolio frequently to avoid unpleasant surprises. Now, I want to hear from you. Have you made any of these mistakes? Leave a comment below and share your experience. If this video helped you, don't forget to hit the like button and subscribe to the channel for more content on investing and financial freedom.